All right, folks. Yesterday, the consumer confidence report came in. It was a bust. It wasn't really good at all. There was not a lot of good things to say about it. So, I'm sorry. So anyway, yesterday we had the consumer confidence report come in. You've got it on your screen. So you can see the yellow line and the blue line. One is present situation, one is expectations. Here's the thing. They're both down. If you look back to 2020, the beginning of 2020, that looks like a million miles away. I mean, that is a long time ago. Now, here's the most glaring statement in there. The October retreat reflects pullbacks in both the present and situation and exceptions index. Here's the line. Consumers continue to be preoccupied with rising prices in general and for groceries and gasoline prices in particular. I want to bring in Bianco Research President Jim Bianco. Jim, this is what you've been saying, that inflation is still a real problem, right?
Yeah, no, it is a problem. It is becoming a bigger and bigger issue. I know that we on Wall Street like to focus on the real side of the economy, but we need to be focusing a lot more on inflation. In that same survey, 47% of the Americans that were surveyed said the inflation rate is lowering their standard of living. The Fed likes to use a phrase that inflation remains well anchored. That doesn't sound well anchored to me. It sounds like people are starting to see their lifestyles change because of the current inflation rate. Now, of course, you might push back and go, but it's only 3.7%. Remember, that is an extraordinarily high number, and it's up 20%. The prices on average are up 20% since the pandemic in 2020. So this is having a cumulative effect and really impacting the way people live their lives. You
know, Jim, I wouldn't push back because I was just going through the data a week or so ago, and I'm looking, and before this run-up, you couldn't find a three-handle. You know, you go to the website, you pull up every 10 years. You got to go back a long ways before there was a three-handle or anything there, even 4%. For this generation, for many people, this is still extraordinarily high, the highest they've ever seen, and so they're grappling with it. In the meantime, you point out that all these experts keep saying to buy bonds is low-hanging fruit. Listen, they've already gotten pretty scorched on this trade, but the good news is that they're long-term. What do you think? I mean, when are bonds going to be a buy?
You know, the problem with the bond market, I think, just to answer that question, is everybody's saying, look at how much yields have gone up. It's got to hurt. It's soaring. It's crushing the economy. A bunch of private equity executives have been saying that for weeks now. But they're comparing it to 2009 to 2020. That was the QE period. That 2009 to 2020, that was the distortion. That was the wrong rate. What we have now is closer to the right rate. I think that what we're going to have to see is where do interest rates go where they really start to really pull back and drag on the economy. I have an outside-the-box view, and it's not the current level. The current level seems to be the economy seems to be able to handle that current level. And that's why I think rates are going to have to go higher before we eventually get that drag. When will I know it? When everybody gives up on the bullish talk about bonds, then it's time to buy it. That's usually the contrarian way things work.
So now here's our dilemma then, Jim. Post-pandemic, our federal debt has gone up more than $10 trillion. The Fed, the balance sheet, their balance sheet went up for almost 4.6. They've run off a trillion of that. But this right here, it's hard to be able to understand how long it takes this to fade away, right? I mean, this is really nuts when you think about it. Yeah, ultimately, a lot of this will find its way into the bank accounts of the top 1%. But until that happens, it's going to continue to add inflation pressure. And then you add government spending on top of that.
Yeah, no, you're exactly right. Deficit spending is just extra stimulus for the economy, and it pushes up prices. And that's why interest rates are responding as well, too. But unfortunately, the way Washington works and the way everything else works, there's only one thing that's going to stop this, and that's the bond market. That is that we take interest rates so high, we make it stop. If you're waiting and hoping for Congress to get together in this committee or that caucus and say we have to rein in spending, look, Charles, I've been on Wall Street for over 30 years. They've been saying this every single day for 30 years, and they never stopped it. And you showed the chart. It's going straight up. The only thing that's going to stop this spending and stop this potential inflation is interest rates go high enough that it shuts it all off. And that's unfortunate that we have to do that. But ultimately, I'd like to think that we'd get somebody in Washington to stop before we have to go to that point. But I'm not optimistic we will.
Yeah, and I hate to say it, too. I'm not that optimistic about that either. Not if it comes down to D.C. being responsible. Jim Thank you very much, my friend.